Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets of the corporate world. And let me tell you, ConnectM Technology Solutions has some really interesting secrets to uncover in their latest quarterly report. Get ready because we're diving deep into a company that's been through a lot and is still navigating some pretty choppy waters. This filing with the SEC is for the period ending March 31, 2025. It's essentially a look under the hood at how the company is doing financially during the first 3 months of the year. Think of it as a mini checkup after their annual report last time around. The company ConnectM Technology Solutions is giving us a peek at their financial health. They're reporting their numbers for the first quarter of 2025. Let's jump right into the numbers. For the first 3 months of 2025, ConnectM reported a total revenue of about $8.9 million. Now that sounds like a lot, but compared to the same period last year, March 2024, they've seen a pretty significant jump. That revenue is up by roughly $3.6 million or over 67%. That's a huge leap, and the company credits a lot of this growth to its new logistics segment. It seems like this segment is really starting to drive sales forward for them. X7459 37, 270, 70, 86 scroll. But here's the thing about revenue growth. You always want to look at the costs associated with it. Their cost of revenues also went up significantly from about $3.7 million last year to nearly $5.9 million this year. So while they're bringing in more money, they're also spending more to make that money. This jump in cost is also largely due to that new logistics segment, which added about $2 million to their cost of revenues. It's a classic growth story where expanding brings in more revenue, but also more expenses. Pro 62 scrolled in 176, 3008 159 scroll. Now let's talk about selling general and administrative expenses. These are basically the day-to-day operating cost of the company. They've almost doubled from about $3 million in the first quarter of 2024 to over $6.2 million in the first quarter of 2025. That's a massive increase of over 98%. The company explains that a big chunk of this increase is due to the costs associated with becoming a public company after their combination in July of last year. Plus, that new logistics segment also added about $353,000 to these expenses. They also saw a significant rise in marketing costs within their own service network. 339, 2603 throw Tiwi. When you put all these numbers together, you see the bottom line. The company reported a net loss of about $6.9 million for the first 3 months of 2025. This is a substantial increase compared to the net loss of about $2.6 million in the same period last year. Yes, their revenue is growing, but their expenses are growing even faster. This is a common challenge for companies that are in a growth phase, especially after going public. They're investing heavily in expanding their operations and building their infrastructure. Scrolly assets at U112, 70, 54,661. After U112, 756. At then 542 scroll. Looking at their balance sheet, we see their total assets were about $12.7 million on March 31, 24 theory, which is pretty similar to what they had at the end of December 2024. Scroll accounts payable, 403. 1996 Atusan Thandon Adand 488 scroll. Ting, however, their accounts payable, which is money they owe to their suppliers and vendors, decreased significantly from over $10 million at the end of 2025. That's a good sign that they are managing their short-term debts better. Scroll debt, net of debt discount, cell 7, 121, 1492, 7, 199 scroll. The total debt also remained relatively stable at around $7.1 million. Scroll liabilities, Kerr, 38, 71, 18, 14, 469, 5 and 36, 7, 500, 43,049 scroll. And when you look at their total liabilities, they stand at over $38 million, which is an increase from the previous period. This means that even though their accounts payable is down, their overall debt picture has actually gone up a bit. Scroll accumulated deficit COPT 2 4,004. Ozenanti Tinoziu 126,099. T scroll Crow. And here's a really important figure to understand the company's history. Their accumulated deficit is over $52 million. This is the total of all the losses the company has had since it started. They have a long way to go to become profitable. Scroll stockholders deficit. AF 25,963,886, 1,507, 10 scroll Tegai Alis also means they have a negative stockholders deficit of about $25.9 million. This simply means that the company owes more money than it has in assets that belong to its shareholders. It's a common situation for early stage companies. Now, here's a really critical part of this report. The company itself acknowledges a significant concern. They state that there's substantial doubt about their ability to continue as a going concern for at least 1 year. This means they need new financing or need to drastically cut expenses to survive. Think of it this way, they're saying they might not be able to pay their bills in the near future without some serious financial lifelines. And to make matters worse, in May of 2025, they received a notification that they are being delisted from the Nasdaq capital market. This is a major blow. It means their stock will no longer be traded on a major exchange, which likely makes it much harder to raise money and can scare away investors. The reason cited is their failure to comply with certain listing rules. They are also behind on payments for a convertible note. While the holder hasn't officially declared them in default, they are technically in breach of the agreement. This adds to the uncertainty surrounding their financial stability. Scroll repayments of debt: 21,000, 81,800, 86,7,258, says Scroll. In terms of cash flow, the company used about $21,000 to repay debt in the first quarter of 2020, $1,000 to repay debt in the first quarter of 2025. This is down from over $67,000 in debt repayments in the same period last year. Scroll proceeds from the issuance of convertible notes at 500. On the financing side, they brought in quite a bit of cash by issuing convertible notes totaling about $2.5 million. This is what's helping them stay afloat. They also got some cash from issuing debt and from some other financing activities, but overall their cash used in operations continues to be much higher than the cash they bring in from running the business, which is why they are in this precarious financial position. Scroll's sales of equity for common stock subscriptions to Peer 3 and 333 Scroll. Looking at subsequent events after March 31st, they continued to issue shares of their common stock. For instance, they sold over 3.3 million shares through common stock subscription agreements, which brought in about $805,000. They also made a significant acquisition in April, buying 2 solar and energy management companies for about $3.2 million worth of their stock. This is part of their strategy to expand their international presence, especially in India. And as we saw earlier, the delisting from Nasdaq happened in May, which is a very worrying development for investors. So what's the big story here? ConnectM is in a classic growth predicament. They're expanding rapidly, especially in new areas like logistics and international markets, but their expenses are soaring and they are burning through cash. The significant increase in revenue is positive, but it's not enough to cover the ballooning costs and that accumulated deficit. The biggest red flag is their own admission that they might not be able to continue as a going concern. Combine that with the Nasdaq delisting and the ongoing discussions about missed payments on their convertible notes. It paints a picture of a company in serious financial trouble. They are aggressively pursuing growth strategies, but it feels like they're running out of runway. The acquisitions and new financing are attempts to keep the lights on and fund their expansion. The company's direction shows ambition with its focus on the modern energy economy and international growth. However, the current financial reality is starkly different. They need to find a way to control their costs and become profitable quickly. Without a clear path to profitability and with the challenges they face with capital markets and debt obligations, investors should be very cautious. This is a company that is making big moves, but the immediate financial risks seem quite high. Alright, that's our breakdown of ConnectM Technology Solutions' latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.